Alrighty, so another quick update as at the close on Thursday afternoon. The S&P 500 had closed up just under 1%. In the top right-hand corner of my screen, you can see we did close up just over 25 points. Another nice sort of long day white type of candlestick. It's not that of a Morobozu. However, we are starting to see again continuation and follow through off from roughly this 2,800 area on the S&P 500. What makes this area interesting is that if I bring up the right template, although we didn't get down into, right, first of all, the sideways moving simple moving averages, right, so they didn't technically act as support, it is giving us an area of confluence of support that the markets themselves, or at least the S&P 500, is holding up above. All right, so you can see here that we did temporarily push down below that rising 50-day exponential moving average. We lasted below this for no more than 3 sessions. This was essentially Monday through Wednesday, and we closed very close to actually breaking above that on Wednesday, but today is at the close on Thursday. We've now pushed back above what seems to be a little bit more so of a sideways moving 50 exponential moving average. Now, what is interesting to point out again is that when we flip on over into the daily time frame and we have a look at our oscillating indicators, you can see during this correction that we have allowed the oscillators, which have been predominantly overbought for an extended period of time, to actually reset. So again, if I zoom out and show you this, have a look at just how overbought we have been really since about the midpoint of January. We have more or less remained above, or at least above what is deemed to be overbought conditions. Most recently, and really through to the actual reversal, which took place on Tuesday, okay, we're starting to naturally correct out of what has become short-term oversold conditions. The stochastics is set to cross. The RSI is already adjusting out of oversold. And again, something that we spoke about yesterday is that the histogram is starting to, or at least continuing to, decelerate, okay, back towards the neutral point. So although we haven't got, technically speaking, a definitive buy signal at the moment, it sure looks to me that as a fair observation, that there is a very high probability right now that we have already priced in, okay, the actual support level. Even if we come on back down and retest the support area, there is a very good chance that the correction itself has run its course, albeit down to 2,800. So essentially we moved from, at the moment, 2,950. We sold off about 150 points down to 2,800, and you can already see a lot of traders, or at least institutional investors, all right, jumping back on in strategically into the market already. So again, this is primed. I cannot, I've repeated myself a lot on this point, and I understand there are some out there who disagree with me. That's fine. I respect your opinion, but it's only a matter of time until these markets crack above these all-time highs. I think deep down, even for the bears out there, you're aware of this, or at least you're somewhat conscious about this, all right? Or subconsciously, you know it's coming. And again, we've been looking at this market and been sort of strategically, right, entering into longer term positions, accumulating, right, as much as we can prior to the breakout taking place. And again, we'll see whether or not we get follow through on Friday and whether or not we actually see a stronger sort of second half to the month of May. There is, of course, the famous saying, sell in May and go away. Oftentimes, or at least more so in recent history, it has more so sort of pushed into June as opposed to sort of the selling taking place in May. But this year, in the year of 2019, we certainly started out a little bit weak. However, we're already starting to claw back, right? Some of those, or at least the initial sort of weakness that began right out of the gate to begin the month of May. Now, again, on the Dow Jones Industrial Average, this actually comes down into the sideways moving simple moving averages on Monday, but you can see Tuesday, Wednesday, and today, the follow through, we closed up 214 points. More so of a long day sort of Morobozu candlestick. Again, technically not perfect, but we're starting to appear to see that turnaround. The oscillators, once again, if I can bring them up, you can see that we're starting to register, technically speaking, buy signals, which is a pretty promising side as well. We're decelerating back towards the neutral line. We are also coming back on up to interact with the exponentials. I should say that because these are moving sideways, so if you just pay attention to the month of May, the month of April, and the month of March, if you just wanted to use this as the cutoff, you can see that more or less the exponentials are moving flat. So when that happens, you don't really pay attention to them. They're not technically support and resistance, and more so what you need to pay attention to are the oscillators at areas of support, which is where we currently are, and also what the oscillators are suggesting when we get back on up into resistance if we fail to break out once again. So again, we're getting confirmation in the markets. It is a little bit premature. Well, the final market is the NASDAQ. You can see again the Stokes, the RSI is adjusted. The MACD is very much so getting very close to that of the neutral point, and we're already starting to see those engulfing candlesticks and follow through back up to the upside. So again, very quick sort of knee-jerk reaction to the news that came out after the market closed on Friday last week. We got the original gap down. We tried to follow through on Monday, or at least we closed below the open, but then again, Tuesday comes along, boom, the markets are continuing back on up naturally to the upside. So we'll follow along with it. If you short the market, it is dangerous. Technically speaking, it is counter trend. Okay, and a good example of that, okay, is this Boeing Airlines trade that we spoke about and the possibility of a whipsaw to the downside, right, below 352.70. This is a prime example of understanding that the macro, the intermediate level of the markets, okay, are still very firmly to the upside, the bullish side, okay? And as such, when you see these technical breaks or potential technical breaks to the downside in the face of a rising market, all right, it's difficult, okay, or at least it makes the odds of the trade working out for you, they do somewhat decrease, all right? So generally, stocks are going to rise, right, as the market continues to rise within the larger equity uptrend. And this is a really good example, unless this is technically speaking a little bit of a back test of the neckline, which could take this stock up to about 360. You just want to watch for, of course, the reversal candlesticks up and around this pivot and then place your entry for the continuation lower. But as such, jumping into it at 352, it did come with risk. And it's a really good example of, again, taking trades or being patient, accumulating positions, or holding on to existing longs, even when you see the pullback, because ultimately price will take out that swing high. And that is the definition, technically speaking, of a continuation of equity prices higher, series of higher highs and also higher lows. If you've got any questions, email me. Otherwise, I encourage you, really do, jump into that analysis class. It is on Saturday morning. There is a recording. All right, so I sit down for 90 minutes, go through the technical analysis on the 3 US market indices, sometimes the transportation average and the Russell 2000, followed by our top 12 individual traders, and also GLD and SLV and the US dollar. All right, so on that note, everyone, I'm going to say farewell to you on this Thursday evening. Have an enjoyable night, and I'll see you over the weekend in that analysis class. All the best. Goodbye.